Cynthia Lummis's digital asset tax bill proposes a change in how mining of coins is taxed. This would be a change to how the IRS guidance reads right now. And I want your thoughts in terms of what people want. Now, some people have been very upset. The logic goes this way. When you mine the coin, you haven't really made any profit off of it. So why should you be taxed at that time? Rather, let's tax it all when you sell it. And the argument goes like this. A baker bakes a loaf of bread. Is he taxed when the bread comes out of the oven, or is he taxed when he sells it to a customer? Ford Motor Company makes a car. Are they taxed on the income from that car when it comes off the factory line? No, it's taxed when it's been sold to a dealer or a customer. So that's how people have argued it. But do you really want that? Because there is a benefit if you have an appreciating coin to not be taxed that way, to rather be taxed the way the IRS sets it up. Of course, the IRS methodology is very tax forward. That is, they try to get as much tax up front. Their plan is to tax you upon receipt at the fair market value in US dollars of that mined coin, and you pay tax on that as ordinary income, which is taxed at your marginal tax bracket, let's say 24% in this example. And then if when you sell it, say over a year later, if the price goes up, say it goes up to 30,000 and you've had a $20,000 gain, then you only pay tax on the delta, the difference, the 20,000, and you're going to be paying capital gains rates, which are lower. So in this case, it would be 15%. So in that scenario, if I play that out on a $10,000 original investment or original coin value, that would work out to $5,400 of tax if those two events are added together. The Lummis bill proposes to do it differently. They propose to tax it all when it's sold. And at one level, you can appreciate that because then you're paying tax when you've actually received income. And that seems emotionally more fair. However, it will come in at a different tax rate because then you're selling $30,000 at 24% tax bracket. You're going to be paying $7,200. So would you rather be paying $5,400 or $7,200 on that tax? Now, you may not like having to pay tax at the beginning, but if you're willing to do it and you can finance it, you will actually save a lot of money at the end if your coin is appreciating, which we all assume that it does. Conversely, if the price goes down, you have a reduction in taxes. It's treated as a tax loss on capital gains purposes. What do you think? I think that a lot of people have wanted this, but I think if you were really financially prudent, you would see the benefit of maybe not going that route and rather paying tax as you go rather than all at the end. Please like, subscribe, and follow if you appreciate this thoughtful discussion. Thank you.